Hey, everybody, this is Charles Dobbins, and you are at the Multifamily Investing Academy's podcast. I am Charles Dobbins, the multifamily attorney, and on this week's podcast, I get the pleasure of interviewing Mike Zlotnik of BigMikeFund.com, and it's F-U-N-D, and you'll find out why I clarified that when you listen to the show. Mike has been a debt and equity investor in real estate for since the year 2000. He started his career and has spent nearly 15 years in the information technology field, managing risk, business intelligence, and quality of complex computer systems. While building a successful career in IT, his passion was always in real estate investing, primarily because of its predictability of outcome and well-understood risks. And in 2009, Mike joined Tempo Funding, LLC, which was a mortgage pool fund. So if you go to look up Tempo Funding right now, you can't get in. It's a closed group for friends only, referrals only. But starting from 2014, Mike assumed the responsibility of the CEO of that fund and began managing TF Management Group and all of its real estate funds. And under Mike's leadership, the company has been transformed and grown. It right now delivers strong returns for its fund investors. Mike holds a bachelor's degree from mathematics from Binghamton University. And if you listen closely, you might pick up a little accent on Mike's part, but you'll definitely learn a ton. And one thing that Mike does that we go into quite a bit in this podcast is a coaching program that he heads up that is very unique. And it's all about starting your own fund. So let's listen. Enjoy today's podcast. All right, everyone here, Charles Dobbins, the multifamilyattorney.com and the founder of the Multifamily Investing Academy. And I am here with Mr. Michael Zlotnik. And Michael, I say Zlotnik, it's Zlotnik. Zlot?
You got it. Zlotnik.
Okay. Now, Mike, I got to tell you, you and I are going to talk about one of my most favorite subjects, and that is the economy, multifamily economy, the real estate economy, what's going on in today's world. And then what we're also going to get into are really, one of your side hustles, or, in addition to what you're doing is helping people, coaching people through setting up funds. And that is, I got to tell you, this is going to be a great conversation because I have so many people that I've advised on what to do and but only to a certain extent. I'm not a securities attorney and I refuse to even play one. So what I want to do is get the nuts and bolts understanding of how to set up a fund, and that's what you do with your coaching program. So let's get started. And my most favorite topic: what the heck is going on with this economy? Where are we in this thing? And I mean, after watching Nancy Pelosi tear up Donald Trump's speech last night, I mean, I don't think she even knows where the economy is.
I'm going to avoid the politics.
I told you, everything's on the table. Everything's on the table. You can say whatever you want on this podcast.
Yeah, I happen to be sort of right down the middle libertarian, and I don't like this bitter bickering and this extreme politics.
All right, well,
it's not good for the country. It's not good for anybody.
You and I are on the exact same page. It's unbelievable. All I want are results. That's all I care about are results. So
that's right, and sort of the economy kind of likes it. If you think about it, the status quo and the political gridlock is good for the economy. Nothing is gonna pass the Congress or get presidential signature. So that's the good news. The status quo. Yeah, we
win.
The environment is low interest rates, which is great for multifamily. Cheap financing, sort of a steady Eddie environment. Fed has turned into a sort of neutral, potentially accommodating mode. And the fears of interest rates causing grief for the economy are gone. So at this point, it's just natural inflation on the rental rates, right? If we're talking about multifamily, what's going to drive the value?
Yeah.
Obviously, value add projects, improvements, older assets being renovated. But if you are investing in core product, natural inflation continues to raise rental rates. Overall, the asset values continue to be steady. So we're not looking for any rapid appreciations as interest rates stay flat. more or less. Cap rates are not likely to do anything worse than what they're doing now. So everything is overpriced. Assets feel like they're trading at a peak valuations. But at the same time, there are no indications, no data points to reverse direction. And the consequence of this, the buyers continue to buy, assuming things are not going to get worse. Possibly even better. Who knows, right? The interest rates could continue to fall in the long run, Japan model, sort of. So all those things said, we are in a steady environment. The stock market is enjoying a pretty good run. What can trigger a black swan event or some kind of global disruption, that disruption could suddenly create a problem for the economy. So today, the steady right is a steady, slow climb or flat going forward. But if there's some kind of a disruptive event, geopolitical or whatnot, we might suddenly wind up in a different environment. But for now, at least what's going on today, it's an election year. It's a steady year. So not expecting any downward pressure. Could be some slight appreciation with inflation.
Okay, let me run through a couple of things that you just talked about. First off, why don't you define for everybody out there what you actually mean by natural inflation? My assumption is that what you're referring to are those inflationary rises that are not the result of any type of fiscal or monetary policy by the government. Is that what you mean?
Correct. It's a classic sense. The CPI is manipulated, so the CPI is low. The real street inflation, in my opinion, is somewhat higher. People continue to earn higher incomes. The ability to pay rents continues to increase. It's just a natural progression. Right. The government continues to print money. So in inflation, it's the supply demand of the money and goods, if you think about it. So as money supply or debt supply continues to increase, it triggers natural inflation. Just things cost more because there's more dollars available in general.
Exactly. Okay. All right. Now
that's a normal traditional inflation is what I'm talking about.
And the thing, we talk about the Amazon effect. I mean, that keeping inflation rates lower, just because the cost of consumer goods are remaining lower because of the Amazon effect, where it's like a race to the bottom, it seems.
Yeah, I mean, the Amazon effect is just if you think about it, it's e-commerce, Amazon. It's a way to deliver goods and services in theory at a lower cost.
Right.
But it is not something it's new. It's been around for quite a while, and there's some level of economic shifts. So some traditional retailers are suffering. So it's moving away from if you're talking about real estate, some of these traditional malls are falling apart, and bigger warehouses, distribution centers are popping up. Right, it's an economic change of what's in demand, but the goods and services are delivered at more or less same price. And if geopolitical issues, don't cause problems with China, we'll continue to get, good pricing from where the stuff is manufactured. So.
Right. Now, you mentioned you said, if I understood correctly, there's no indication right now to show that things are changing. Like we're not seeing, we're not seeing those types of issues that we saw back in 2007, 2008 in our economy right now. So you're saying you're not seeing any indicators that this thing's going to blow up anytime soon.
That is correct. There's no data supporting major down. There are no massive cracks in the ice. There's overpricing in general of assets. The PE expansion, you've heard of that term. It's used in Wall Street. Yep. Same thing happens for the multifamily asset. The cap rates are historically low.
Yeah.
But there are no imminent pressures to change that. So it's a steady environment where supply demand is balanced, and quality assets go for a premium price.
But you say supply and demand are balanced. I'm seeing that demand is so much higher in certain areas, certain markets. Demand is so much higher. We just can't fill it fast enough.
Right. So there are sub pockets of the economy where the buyers are still coming in. Let's just call them. You're talking about multifamily markets.
Yeah,
right?
that's pretty. Yep, that's all I know. That's the only thing I know.
Well, it's a great area, right? It's probably people need to live somewhere. That's the bottom line.
It is. I tell you, it's the numbers just make sense. From an operational standpoint, You're right. There are some areas that are just so white hot. The numbers just don't make sense. I mean, I've actually seen areas seen deals come across my desk in California where in order to get the debt coverage ratio to even pencil out at like a 1.2 or 1.25, you got to put 50% down on the property.
Right. Remember, I live in New York City, right?
Okay.
The same thing happens. So the cap rates here are sub 3. They're very, very low. And if
Yeah.
you get bank interest rate is higher than the cap rate you're paying.
Yeah.
Unless you put a massive down payment, you can't acquire anything.
Right.
Yeah. So that is absolutely correct for these coastal markets where people are overpaying for the assets. They don't care about the cash flow. The cash flow can be barely break even after 40, 50% down. And then it's an appreciation game. I mean, New York City, again, I know California, many markets, but behavior is pretty similar. In these hot markets, some markets, the appreciation rate on these assets is the only way to make money. But it's not sustainable. How much can the assets can appreciate when the rent inflation is not keeping up with the price inflation for the assets? So that's the phenomenon that's going to put the brakes on the price appreciation. Now, if rents continue to escalate at a rapid pace, in New York City, they have been going at a well above inflation, let me put it this way, then you have the justification of a higher prices. But rent controls, affordable housing continues to come in, and it's a big political issue. I know developers in, for example, LA, who lease church land to put new multifamily housing with the affordable twist. And that stuff is hot for sure.
Yeah. Okay, so let's get back for a moment. I really like what you said about the cap rates are above the interest rates. I'm sorry, are below the interest rates. You're paying more money for the property, but you're hoping for the appreciation. But if the rental increases do not maintain and continue to grow the way you're hoping, that's a recipe for disaster because you're never going to get your money out of that.
Yeah, I mean, I'm a big proponent of the cash investing, right? If you're investing for cash, you have pretty, that's your safety mechanism. You have the cash flow.
Yeah.
But in these markets, you're investing is for appreciation. You're speculating. You're speculating that somebody else, the greatest fool theory, there's going to be dumb and dumber money. I use this term from time to time. There's going to be a dumber money. It's going to pay more for the same assets with even lower cash flow. It is amazing how it can happen.
Yeah.
It can happen, but it's a speculation. It's a speculative investment versus sort of cash flow focused.
I just interviewed a guy who said that one of the reasons why multifamily is so incredibly hot right now is because foreign dollars are willing to buy at a zero cap just to get their money out of the country into some hard asset in the U.S.
Correct. That's dumb and dumber money. It is money that's escaping political persecution, political uncertainty. U.S. is still the greatest political experiment in the world. Our system is still far better, with all its problems. It's still far better than many other dictatorship or totalitarian governments. I mean, I originally come from the former Soviet Union many years ago, and I could tell you, running away from the socialist and communist country, this is a whole lot better, even with all its problems.
Yeah, but Mike, I watched the State of the Union last night, and there are no problems left. I mean, they've all been solved. I watched the State of the Union. Didn't you see it?
Don't get me started in politics. It is. It's
I'm
sport,
keep
right?
Needling you.
No. I have these discussions with my oldest daughter, who's Bernie Sanders fan. My second daughter is Trump fan, right? My third daughter is the only girl in the class. This is 4 years ago when she was a small girl. When they asked them who's running for president, she's the only girl who raised her hand and said Gary Johnson, a libertarian, many years ago. So I have a very diverse household, and we have different opinions.
Oh, let me just say, I've got one kid that lives in Harlem, and he's my Bernie Sanders bro. And I got one kid that lives down in Alexandria, Virginia, goes to school down there, and he's my Donald Trump dyed in the wool. And listen, I'm the libertarian in the family. I get it from all sides as well. So I feel your pain.
It's not a pain. It's just it's a diverse it's a diverse environment. Yeah. I don't want to spend too much time in politics, but I just
we get all the time in the world. We get all the time in the world, Mike. We get all the time.
But I do want to say that I sincerely hope that politicians find a way in their heart to go to the roots of the country and what the founding fathers wanted us to do, instead of worrying about their reelection and constituents.
Exactly.
In a pure sense, it's reelectability. a lot of this playing, a lot of this pressures in the impeachment trial is just to please the constituents. It's not about getting anything done. When they started the whole process, it was doomed to fail. It would never get 2/3 of the Senate.
They knew it too.
So it's just a waste of practical time, but it's a show. They're having some kind of show. They feel good about themselves on one side, and on the other side, it's the same message. Let's get back to business and run the country. And I don't know when it's going to change, but today it feels like too partisan politics. It's just too much of it. So.
Yeah. I would tell you, the Constitution, greatest experimental document in the history of mankind, and primarily because of how it prevents government from doing things. I
bought this little thing on an airport travel, and I'm reading Declaration of Independence and the Constitution. This is a beautiful, fundamental, most profound document, and the founding fathers, the framers, knew something about human nature to the degree which we happen to not even worry about. But the consequence is, this is a great book. You know, you could say this is the greatest book after the Bible, but it is a great book of the modern age, and we should stick what's written in the book, not inventing what it could possibly mean beyond what's written.
Yeah, let people solve the problems, not government. Government has always screwed up everything they've ever tried. And when we see that with health insurance, we see that with Social Security. I mean, everything goes bankrupt with the government. Let us do our own thing. Leave us alone. But,
final comment on this. You're going to laugh. Okay. Let's switch to the setting up the funds and multifamily syndication.
Yes.
So I had a debate with my oldest daughter, who's a Bernie supporter, about Medicare for all. Right? Yeah. It's a great concept, but I call it socialism, which is a utopia. Great ideas. No great idea goes unpunished, because practical world, when you set up a single payer system, the government is in charge, you get bureaucrats, it breeds two things, right? It breeds corruption. People who are in charge, who make the decisions, they're motivated to favor some level of special interests, right? To say the least. The second thing that happens, the government is going to be influencing the pricing and the amount of care. Somebody's going to make these decisions. So what happens when you have free care? It's sort of Canadian model, but I've seen a worse model, like the original former Soviet Union, where you get free care, but if you don't have money to pay for the drugs and for additional specialists and everything else, nothing gets done. You get what you pay for. Free means you get very low level of service, a lot of corruption and abuses of the system, long lines, and in fact, the system gets much worse. It destroys competition, and it creates a very inefficient and ineffective healthcare system.
Amen, brother. Amen. I mean, and I know Medicare. My family owns a Medicare insurance agency. And, you know, I think Medicare is great for people, you know, age 65 and over. And already it's running out of money because there are just too many people and not enough money going in. But to do it for everyone, you will have to ration care. You will have to cut back on doctors. The quality will plummet. And that's not what we want here in this country.
That's right.
Are there alternatives or other ways to fix it? Yeah. I think eventually, you know, age 65, that's going to become a made up number. I mean, I'm never going to retire. You know, I'm going to keep on working. So, you know, at some point, I think that age 65 for Medicare is going to go the same way the Social Security goes, where it just gets a little bit older and older, or you buy in at a different level or something like that. They just have to make it. They have to solve the problem because it's running out of money. But I think Medicare is the best government program next to the Defense Department. But in the form that it's in now, and we've got to fix the form now. But you cannot open it up to everybody.
It's unsustainable in the current.
It is unsustainable. You can't do it. You just can't do it.
The IOUs, the liabilities that are coming to pay for the future care of all the retirees.
Yeah.
There's no money. There's no budget.
Yeah.
And the only way they're going to do it is to keep printing national debt and just keep financing. That's the only way.
So what we've done before, but they are going to have to go up on taxes. They are at some point because of the debt. It just has to happen. So, all right. Anyway, let's talk about money, Mike. Not that money. Let's talk about our money. So, you have the name of your company. First of all, we got TF Management Group. Oh, that's what popped up as when I typed in Tempo. Let me talk first off. Let me get back here because I lost my page. Hold on a second. Where is Mike? Okay, first off, one web page I want everybody to check out is go bigmikefund.com. Okay. Now, in this web page, Mike is. I got to tell you something, Mike. When I went through your information, I realized that holy cow, I've been doing this for 10 years, and I've never met anyone that does what you're proposing on your website from a consulting coaching standpoint of how to set up a fund. And, I keep telling my students, the panacea in this investment business is when you get to a level that you've got your own fund. And in the last couple of podcasts that I've done, I've spoken to guys who do have their own funds. They've set it up, and it's just a much easier way to do this business is when you have the funds available in a global fund. So, but getting to that stage, everyone starts off basically as what I call a one-off. You're going to find that one deal. You're going to go out, raise the money for that one deal, and then you're going to move on to the next one.
That's right.
And then as you start to get bigger into the bigger deals, then you need to have that capital ready to go when you find those deals, instead of having to find the deal, then go find the money. So what you're proposing, let's talk about setting up a fund. What's your experience with? Give me your sales pitch. I'm going to do what I did before. I'm going to write down notes as you speak and then jump in and get your thoughts on it. So the table is all yours.
Sure. So my job number one, I'm a fund manager. I manage a few funds. We have Tempo Opportunity Fund. We have Tempo Growth Fund. These are some of the core funds. And we have a number of other auxiliary funds, sort of legacy funds, I call them. So I have a ton of experience setting up the funds and running the funds. Running a fund or having a fund has a lot of benefits, as you mentioned. One of the key benefits, you have dry powder on sidelines. So as a fund manager, you continue to raise capital into the fund, and you offer investors a diversified portfolio. It's one of the main benefits. So if you have one multifamily syndication, and then you have two, and you have three, and you have a range of them, and you can all sell them into a fund, at least in the initial transaction, or you acquire one and then two and then three, you build a diversified portfolio, which is a lot more predictable from a returns perspective versus a single asset. So fund has that significant benefit of a diversified portfolio. Two, as a fund manager, you're raising capital ongoing basis. The capital raising for a single project is a little bit different from raising the capital into the fund. Why? Because a single project is selling a specific syndication. You're selling specific location, specific value add, specific strategy, specific return, specific cash flow, and whatnot. When a fund, you could use examples of what you got in the fund, the type of deals you already acquired, but the next deal is just unknown. You're raising capital in general for the next deal. Now, as a fund manager, you could choose to keep the capital in the subscription account or pull it in whenever you're ready to go. So you have a little bit of flexibility where you could get folks to line up with capital ready to go, then you find the deal and you can pull the trigger. So the fund has that elegance that you as a fund manager are in charge of the decisions, and you can raise some or have ready or committed dry powder when you have a deal coming up. Just a basic overview of how it works.
Now let's talk about before we start getting into the 10,000 foot view. What size funds are we talking about? How much? What's a typical starting? If someone's just starting out, what type of fund size would they need, and what is the reason for that number?
Right. So this one is a legal paperwork, PPM, and what's written in the PPM, and two is a practical ability to raise capital. Those are different things. So when you write a PPM for a multifamily fund, you generally probably are going to write $50 to $100 million fund, right? You're not going to write a fund for $5 million. You certainly may, but why? There's no benefit writing a small when you can write it big. You could write it for, depending on whether you're going to run a closed-ended fund or an open-ended fund, you can write a 25 million, whatever you're comfortable with, but write it at a pretty high upper limit, and knowing your ability to raise capital for individual deals over a certain amount of time, write it as optimistic as you can. Why? Because there's no drawback, almost no drawback. So you're right, that's PPM. So you can raise a fund up to $100 million. You know you may only raise 20 million or 10 million. But it doesn't hurt to write a PPM that has upper limit, right? If you're writing an open-ended fund, it could be evergreen, and you probably want to write it for 100 million. If you're writing a closed-ended fund that's going to raise capital for a period of, say, 2 years and then close, then you just have to know of your own capacity. Can you raise 20 million? Great. Can you raise 40 million? Great. So write it at whatever upper limit you think you could do. The second part of the whole strategy is capital raising. It's another discussion. It is ongoing exercise. People get better and better over time. They build their networks. But capital raising is going to be critical. The fund is a vehicle, but your ability as a fund manager or a multifamily syndicator raise capital, it's going to be up to you, your network, your marketing that you do. Do you use other promoters, or do you go to the audience directly to a lot of people through your own network and marketing? So they go together. I'm working with a couple of folks today, and part of the coaching we do is how do we build a plan to raise capital? It's different for different people. We raise a lot of capital through affiliations with strong groups that have capital. I have friends who have massive podcasts. They have massive educational content, and they raise capital through that from a lot of mom and pop investors. And the fund structure will need to reflect that you're going to get only accredited investors, so you need to go to a bunch of potentially non-accredited. So before you go write PPM, you should absolutely think about who you're going to raise the money from, to what degree, and as long as they align. I propagate. I don't know if you like this, but I certainly love 506C funds. The Bs are possible, but the Cs are much more. You could advertise them. You could essentially go spread the word on the street, continue to market them, and raise capital, but you're limited to accredited investors only. So it's just a consideration. It's a trade-off depending on what you're trying to accomplish. There's more money with accredited investors. You're likely going to get bigger checks. That's why I believe it's better to go that way. So.
Okay. All right. Now, one of the things that you need to do with a fund is you need to have an investment philosophy or investment strategy. And right. How specific do you get with that? Like could you just start a fund that says we invest in multifamily property, period?
Yeah, absolutely. So there's two philosophies in this, right? So Tempo Opportunity Fund has a very broad mandate. We can opportunistically invest into anything. We could do multifamily, self-storage, office, retail, hard money loans, anything. When you have a broad mandate, it's really up to the manager to do what. It is a little bit harder to sell a fund like this if you're going to investors. So specific strategy may be easier to sell. For example, the fund could be a growth fund, and you're only going to invest in significant value-add multifamily projects. It's a strategy much more narrow. Your universe of deals will shrink to only those type of deals, but it's easier to articulate that strategy to potential investors. Does that make sense?
Yeah, absolutely. Yeah.
There's no right or wrong. It needs to be discussed and decided what would you like to do. I certainly like a little bit broader mandate, but you may, as part of the offering, say, within the offering, we're planning to put approximately 40% in the value-add multifamily, 40% in kind of performing assets, and 20% opportunistically into whatever really makes sense. Could be extremely high-end, extremely high value-add multifamily, almost massive redevelopment.
Yeah.
Or could be ground up, or could be anything. So you can still go out with a broad multifamily fund, but within the mandate, you could break down subsections. What are you allowed to do? How much can you put in each sort of sub bucket? Does that make sense?
Yeah. Now, let me ask you something about the other issue that comes up with having a fund is what we call the velocity of cash. Meaning you have you get the deal funded, you get the fund funded, but you still haven't found any good deals yet, and the money's sitting there.
Right. So that is a key question to ask. What to do? Right. Yeah. That's what happens with closed-end versus open-ended fund. When you run a closed-end fund, just to give you a perspective, you're getting commitments from investments. They may wire in their money in a subscription account, but you're communicating with them until I have a deal, the money is not going to be working. So what you're doing is you're preparing the dry powder. And when you have a deal, you do capital call. You basically say, listen, guys, you committed $500,000. For this deal, we need $250,000. So it operates a little different versus an open-ended fund. In an open-ended fund, we subscribe to money quarterly. So if it's January 1st and there is $1 million of subscription capital, we have to pull it in. So it starts earning a pref from day one. It starts burning a hole in the pocket. So we don't want to have a lot of money in the bank per se. So you really have to design your fund in relation to what you're going to do. And you may need to be prepared to have some dry powder on sidelines. Really depends on who your investors. And you could do a fund where effectively, until you have capital, until you have a deal, you are not mandated to take the capital in. So you will not subscribe the money until the deal happens, and that's the prudent strategy. Otherwise, you have, cash in the bank that's burning a hole in the pocket.
Exactly. Yeah, and a bunch of investors are unhappy.
Most of real estate is done on a pledge and a capital call. Does it make sense?
Okay. Yeah. So you get a commitment of I commit $100,000. Well, I only need 25% now. We put 25 in. But when I'm ready to make that, when I need that other 750,000 or 75,000, you better have it ready. And
that's right. And most of the prudent managers or syndicators, they overcommit, and then they can always push somebody back or cut them down. So when you overcommit, if somebody bails out, somebody got sick, they can't wire in their committed funds. You got to deal with that possibility.
Yeah.
That you overcommit, then you have more than enough capital. You close the deal, and those who failed on a pledge, there's some consequences, and those who came in at the last minute, they got a bonus for stepping in, something like that.
Getting in. Yeah. All right. Let's talk about the operations of a fund. And why don't you tell me the difference between the operations from a fund and versus a one-off type of investment thing, and even if there is any difference between the two.
Certainly there are differences. The primary difference is a fund has many assets while a syndication is one asset. From investor management, you have a bunch of investors. It's a pooled investment vehicle. So they could have invested in a fund or they could have invested in a syndication. It doesn't make any difference. They still got to get their quarterly statements. They're still going to get their quarterly updates. So from investor side, it's pretty similar. From an asset management side, a little different. You're managing one asset versus many assets. And that is not fundamentally different, right? If you are operating each asset well, then it's just going to go into the fund. Depends what kind of information you're getting from each asset. Like when we invest, we're mostly, as a fund manager, our approach is invest passively with the right actual operators. So we get a statement from each asset on our position within that syndication. So fund has to look at these quarterly statements from each asset, and then what cash flow we receive from each asset, and what's the life cycle. And that's the big difference versus a single asset deal. There's there's only one asset to update. So your update cycle to investors within your fund is a little bit more comprehensive because you have more than one asset. The other thing is you should certainly use as much as you can third-party administrator. We use Redwood Real Estate Administration. It's a third-party administrator. And it helps quite a bit because they generate statements and they help us do the books for the fund, including all assets within the fund. So having an administrator as a fund manager will simplify your life. Having an administrator as a syndicator will also simplify your life. There's a cost for sure, and you have to build it into your P&L and the projections as it's going to be administrative cost.
All right. I mean, you have to do that. Now, first off, before we get into more about Redwood Real Estate and what they do for you, what regulations exist as far as what you are responsible to produce for your investors? Like, for instance, you mentioned quarterly reports. Is that a regulation, an SEC regulation? Or is that just your decision as the fund manager? You want to do quarterly reports. What are you obligated to do?
It is a good practice. What you're required as a fund manager is to file Form D with the Security and Exchange Commission, right? That is you're registering a PPM, private placement memorandum, and then you will have to do blue sky filing on a state level, depending on where you're raising the money. And I'm talking about right now 506c fund. You could do in-state offering, which is a different conversation. We do only 506c offerings, and the blue sky filing, you need an SEC attorney, essentially to file with the. We have certainly connections. We can introduce you to the SEC attorney. They'll file Form D with the SEC, and then they'll have to do blue sky filings on quarterly basis with each state. But you do it only once. Once you get one investor from the state, you file. If you get 10 more, you don't have to file 10 times more.
Right.
In general, these are unregistered securities. So there is no quarterly reporting required. If you're a public security, then you have to file quarterly. With private security, you don't have to do quarterly reports, but it is a good practice. So we do quarterly reports, we do quarterly investor calls, and we do quarterly statements done by our fund administrator. All this is just good business. You want to keep in touch with your investors. You want to make them feel good. Because think about this: what investors ultimately looking for? There's a few things, but there are two fundamental things. Number one, they want to get a good return. So if you're distributing cash, that's a return. If you are doing a value add, then it's a growth project. They want to feel good. The second element, that the project is going in the right direction, and that's communications. So just a good practice to make sure that your investors are up to the date on what's going on in your fund or in your syndication.
All right, now tell me about working with you, because you not only are a fund manager on your own, but you also help people set up their own funds. What does your coaching entail? And this is a thing, Mike, where I say, because this program is evergreen and it's going on my website forever and ever, we don't talk price. If anybody wants to talk price with you, they contact you directly. But what type of services do you provide with your coaching?
Sure. So the primary coaches help folks to set up a fund or a syndication. Do a couple of things. One is do strategic planning up front before they go and start working on a PPM. Understand what their business is all about. Kind of take through the process of setting up a fund, thinking through financial model first. Right? What are you going to invest in? What kind of returns to investors? What kind of return to you? It has to make sense to both. You don't want to set up a fund with the best structure for investors. You don't want to set up a fund with the best structure for yourself. So both parties need to be motivated. Also, sellability of the fund to raise money. Right? I see too many sponsors set up the deal that's good for them, but they can't sell this fund to semi-professional investors, to institutional. They can only sell it to mom and pop with no clue, right?
You mean like those guys who put in a 5% acquisition fee into their
yes,
PPM?
yes. They say they have 5-6% acquisition fee, disposition fee, development
asset
fee,
management fee.
Yeah. So that's the problem. And the waterfall is unprofessional. And they have a pref, and it's not cumulative, and they have the split that favors them. That and they are brilliant marketers to idiots, pardon me, to unsophisticated investors with no clue. They may raise some money, but it has no lags, no scalability. You got to set up a professional fund so that if you approach a ultra high net worth investor, and you got to give them the Class A units, the best units, they get them a good pref and a good split because they're going to write you a big check. And then you have a few other classes of shares that if you find other investors, it's still attractive. You certainly want to eat, right? You want to have some kind of asset acquisition fee, but not outrageous. You do want to have the lights on. So that whole process of designing what the fund should look like is what I help folks with. That's a sort of one important element. Once we go through that, once we go through the fundamental sort of, let's just call it financial structure and general guidance of what we want to do. It's ongoing coaching. Then the next step is you engage the SEC attorney, and they write a PPM from you, and then you go through that process. Once you have a complete, you register, you should have already a capital raising plan. We work on a capital raising plan. That's the next step. So one is strategic discussion, what the fund should look like for capital raising and for compensation purposes and for what its assets is going to have. Two, take it through a legal process and parallel build a plan to raise capital, and then start executing on a plan. And then you keep rolling forward. As you go through the fund, there's a quarterly process. Folks ask me, what should I do on quarterly basis? And I'll guide them through the best practices already running a fund. So it's ongoing process, not a one-time exercise. It helps them set up a fund, and then run a fund with good practices, good communications, and continue to market and evolve marketing strategy as results come in. And then we'll have some strategic advice what to do in the early stages of the fund, what to do at the later stages of the fund, because things change. When you have one asset, it's harder to raise capital. If you have a syndicator and you have 2 or 3, 4 other deals, you may want to come up with the first transaction acquisition. The fund acquires that little portfolio, and that becomes no longer a single asset fund. It becomes easier to raise it. So it's what I try to do is to help folks design a custom strategy, and then once they get it going, how do they continue running it forward and improve it?
Oh, that's great stuff. I love that. That's because I tell you, I don't know many people that do it that way in that nitty gritty. You got to be an expert at setting up your own fund. I know multifamily law. I don't know how to set up a fund the way you do. So great stuff. Let me ask you one final question, Mike. What's the biggest mistake you see new investors making?
It's a good question. I don't have a straight answer other than they set goals well above their means. I'm not saying don't reach for the stars, but know yourself, know your own capability. So if you have an ability to do a deal of $3 million equity and $7 million debt, focus on that. So the mistake is you see a pie in the sky. You see somebody else doing big deals. You go to a guru's webinar, and then you learn, hey, you could do $20 million raise and $100 million total capitalization. Great, but you are not there yet. You don't have the connections. You don't have the network. So not knowing how to look for the right deal is what they spend a lot of wheels looking for deals. They don't have ability to take them down. And we don't interact with too many novices. That's one thing. So I mean this with all due respect. But I try to tell people, be practical. I mean, what is your target? I'm not saying go look for these small 50-door, 75-door assets, but they're certainly easier to raise capital for, and maybe it's a learning experience. So until you have some experience dealing with them, your first assets should not be gigantic. Your alternative to that is you have to find a partner. But why do they need you? What do they bring? What do you bring to the table? Why they need you?
Or even the other question is, how do you know that partner is the guy who can do what you think you need?
That's right. That's the difficult part. Is easy to partner, hard to break partnerships. So make sure you partner with people who you know, like, and trust, because it's not, you get into a deal with them and they're not good partners, that you'll not enjoy that experience.
Michael Zlotnik. You can check him out on, you can reach him at mike@tempofunding.com. I recommend if you're looking for hard money loans, go check out Mike at tempofunding.com. Or it's actually, it's tempofunding.com.
Right. Just be very clear. We do business strictly on referral. Hard money business, we don't need clients anymore. It's a very closed, it's like a private club today. So I appreciate the referral. We're not looking for my business. Then
go check out Big Mike Fund podcast. He's a podcaster also, and how about bigmikefund.com?
That's a perfect site. Yes,
perfect site. So bigmikefund.com, and you can check out Mike. Mike, thanks so much for being on the Multifamily Investing Academy's podcast.
I'll add a final comment. I like to crack a joke, and it's a good joke. So if you go bigmikefund.com, you're going to find me. But if you misspell it and you go bigmikefund.com, I promise it is not a kinky site.
It's like when you type in whitehouse.com. Whoa, don't do that. Don't make that mistake. It's whitehouse.gov. All right. Michael, thank you so much for being on the show. It's good,
Thank you, Charles.
Good meeting you. And we'll talk soon.
Likewise. Take care.
Bye-bye.